Is a housing collapse here? Has it already been here for a few weeks? We just didn't notice it. That's today's show, and the numbers are not good, folks. Hey everyone, I'm Clayton Morris, longtime real estate investor. We're building a lot of properties this year, but tonight's show I want to talk about the retail housing collapse and what that looks like and how it's a lot different from what I do as a real estate investor. See, whenever you see scary headlines like this, take a look at this. This is CNBC this afternoon. Consumer confidence in housing falls to its lowest level since the subprime crash. Now, what's playing here? If you think about all the people who are looking to buy a house or looking to sell a house, this is a huge problem for them. Consumers suddenly have become much more pessimistic of buying and selling conditions, and more consumers said their household income is now significantly lower than it was a year ago. So look, the housing market had enormous demand just a few short weeks ago. The housing demand in this country was, through the roof, pardon the pun, but we had incredible demand for houses, and it was going to be probably the biggest spring buying selling season we'd ever seen in the housing market. Can you imagine? Like if you're a realtor and you're gearing up for this and you're thinking, oh man, April and May, the two biggest months, best months to sell a house, showings, realtors making great commissions, womp womp, terrible, terrible. So some of the data right now is unbelievable. Individuals, if you take a look at this piece, you get to see some of the numbers that interest rates are hovering near record lows, right? That's keeping buyer sentiment slightly ahead of seller sentiment right now. 46% of people said it was a bad time to buy a home, while 65% said it's a bad time to sell a home. And what they're seeing is this is the lowest consumer confidence in the house market since 2011. And it fell sharply in March and this is of course to the Fannie Mae Home Purchase Sentiment Index. So what will we see as a rebound? This is a big question. Well, there is some good news out of this data. The numbers are expected to get worse in May before they get better, but there is still a lot of demand. There's still pent-up demand for people to buy homes. And showings have started to open up again, not just those virtual showings, but actual showings. But 3 in 4 potential sellers say that they are preparing to sell their homes following the end of the stay-at-home order. So, if you were a seller, 3 out of 4 of you are going to continue to sell your home, according to a new survey. But we're seeing price drops already, folks. I want to go through some of the data here on these price drops because we're seeing some price drops now upwards of like 20%, 22% in some markets. So what would drive a housing collapse? Well, I think a couple of things, right? The mortgage side of things. So let's talk about that for a minute. And let me explain briefly, not to bore you to tears, but let me explain briefly what happened back in 2008 during that crisis, because it's like Groundhog Day. It's happening all over again, and we didn't learn our lesson. Well, let me explain. So in 2008, right, during that crisis, what happened, right? These big banks, as soon as they would get a mortgage, they would sell it off. They would sell it off like immediately in what was called a collateralized debt obligation, CDO. They would sell them off in this package, okay, to the private market. So a lot of the private market ended up getting a lot of this money, these mortgages. They were not being held. If you got a mortgage at Wells Fargo, it was not being held there. It was immediately sold off to somewhere else. Bank of America had it for a short time, sold it off. And then what they also did was they used those large insurance companies like AIG. So they had these big bundled up mortgages from people that really couldn't afford to have them in the first place because they didn't even have jobs. Then they had insurance from AIG backing these like junky mortgage balls of garbage, right? But they had insurance. So they were covered. But guess what? AIG had all that money in a big pool. And I remember Ron Paul on television saying, the real story here will become the insurance companies. And everyone's like, what are you talking about? And he was right. He was 100% right. Because what he saw were these junk mortgages, but he saw one step beyond that, which was that the insurance companies didn't have any cash. They took all of this money because they're like, the housing market's never going to collapse. Sure, we'll insure these junky mortgage balls that you've made. Sure. But then guess what? Of course it collapsed. And so the insurance market collapsed also because they didn't have any money to be able to pay the banks back for these risky gambles on these mortgages that were a total flop. And then, of course, we had a massive foreclosure crisis in this country. Defaults out the wazoo, people's credit destroyed, and now a lot of foreclosures have pretty much dried up across the country. Foreclosures have really become a rare bird. As real estate investors, those were some of the first few properties that I ever bought were foreclosures. I bought one short sale, one foreclosure, my first two properties in Michigan that I ever bought. And I still own them today. But those all but kind of dried up because mortgage, now it's very difficult to get a mortgage. If you want to get, because the next problem is on top of this, folks. So now let me just kind of paint a picture. That was 2008. Now they've renamed it. It's not like CDO, it's BTO, which stands for Bespoke Tranche Opportunity. And now they're doing it again. So this started happening in about 2015, where these banks didn't learn their lesson and started packaging up loans again. But ideally, the people that were, in these houses paying their mortgages actually had a job, actually could afford to pay their mortgage, right? That was 2015, so it was a lot different. We had the Dodd-Frank Act, we had all of this. Well, now these BTOs are the same thing. And now you're seeing it difficult for people to even get a mortgage. You need about a 700 credit score like JP Morgan, 700 credit score and a 20% deposit. Well, guess what? So anyone that got a variable rate loan a few years ago, right now in this scenario, so just hear me out. 4 or 5 years ago, things are good. You get a variable rate mortgage. You think you have a good job, right? You have a good credit score, and you get one of those 5-year adjustable rate mortgages, right? Great. Then COVID-19 happens. You lose your job. You have credit debt that you can't pay. Your credit gets hurt. Your credit score goes down. Now you can't pay that loan, and now it adjusts, right? And now this adjustable rate mortgage adjusts, or you were going to refinance out of it. Like you were going to refinance into a new loan. And now the lending restrictions are so onerous that you can't. And what happens? Foreclosure, default. And here we go again. It's all coming right now because this adjustable rate is about to boom right now. Again, like we went through this before. We did not learn our lesson. It's here again. This adjustable rate mortgage thing. It's like I see it right now with people trying to return to work and go to parks. They're kind of like, we have like a short-term memory loss, like Dory in Finding Nemo. Like, did we not forget what just happened? So I see people out at parks and it's like, really? It's like people didn't remember what happened in 2008. It's happening again. So anyone who can't meet that 700 credit score means less people are going to be able to purchase houses. This is going to dramatically affect the supply and demand curve, and it's going to turn from a seller's market to a buyer's market and possibly even a finance-based market. Then it's going to turn into what it always does during these scenarios, folks. It's people like me, real estate investors, who are able to swoop in, and it becomes a cash buyer's market. So when I was able to swoop in and buy some of those foreclosures, I had some cash in the bank. But guess what? Most people don't. I had some savings. Most people don't. Most people spend 100% of their income and have no savings. So what's going to happen here, folks? We now see the forbearance numbers. Let's put these up. Here's the latest forbearance numbers. Fannie Mae already has 1 million mortgages in forbearance. And they think that number may double. They think that number may double. Well, guess what? That's just Fannie Mae. We're already hearing from Wells Fargo that they have, I believe they have 2 million already in forbearance. And the federal government is asking these banks, like, give us your numbers. Like, how many people are asking to get their loans, like take a break from their loan for a few months. And it's difficult to do. Like, these forbearance programs are not easy. And so if you do not need to have a loan forbearance right now, don't do it. If you're able to pay your mortgage, keep doing that, because there's a ton of paperwork that you have to fill out. And you will have to pay it at some point. They're just basically going to give you a break for a few months, and then you will have to pay it. But Fannie Mae, 1 million mortgages already in forbearance, and they think that number will double. Tomorrow, of course, we're going to get the jobless numbers. And last week, we saw 3.3 million additional people go out of work. That's on top of the 30 million that we knew of from last month's jobless numbers. Tomorrow, we get those jobless numbers, folks. And we're going to be reporting them right here. And it's going to be, it could be the worst we've ever seen. Bigger than the Great Depression already. We're already seeing that in Britain. This is their worst economic downturn since 1706. 1706, 300 years. They didn't even have it this bad during World War II, according to their numbers. Not even close. All of London was destroyed. I mean, and they didn't even have this bad of a situation in the UK. So one of the biggest mistakes I think the government, have to make right now is they've allowed, or one of the biggest mistakes I think they've made is they've allowed people to not pay their mortgages and their loans without needing to prove financial hardship. And that's a huge mistake. That's a huge mistake for a number of reasons. Can you name them? Because it's like getting some free money even if you're not even facing a financial hardship. That's why I've just told you, don't do it. Like, if you don't have to do a forbearance, don't. Because this is going to leave the banks running out of money. Banks are going to be running out of money because these people aren't paying their mortgages when they should. And then Wall Street, or then the federal government's have to bail out these banks the same way all over again. But the problem is this time they don't have the money to do that. The Federal Reserve already has $6 trillion on its balance sheet because they never paid off the first $4 trillion that they did a few years ago. So the next thing we factor in here is inflation versus home prices. And if we don't see the actual number, like the price of a house going down, which we're already seeing in some markets, it will still be going down because inflation's going up. So the value of that house is not going to keep up with the rate of inflation. Now, real estate has always been, or largely been, a hedge against inflation. And what I'm trying to explain to you here is this is what we're looking at is the retail housing market. So when you see headlines like this, if you're a savvy investor, you understand that what they're talking about here is not for you as a real estate investor. They're talking about this for you as a home buyer who's going to live in a house. That's all mainstream media does. They don't know what we do as real estate investors. They have no idea what we do. So they don't know that we build our properties and rent our properties in like very recession-resistant cities that don't have these crazy swings of numbers. They don't know that. So what we're talking about with these mainstream media headlines is home buyer. I want to buy a home and live in it. I want to sell a home and move somewhere else. This is what's collapsing. And the people that rely on mortgages to live in a house with their job and income to pay that mortgage, like the middle class mistake, is about to get crushed. And we're seeing it already. So I think, we're going to see big swings. I think we're already going to see, certain swings in some areas, like 40% declines, 30% declines in some area in home values. It'll be curious to see markets like Boise, Idaho, which is one of the best retail housing markets. It's not a place I would invest because I think the prices are too high and the ROI doesn't make sense for me. But it's listed as the #1 housing market for the retail home buyer. Good schools, new business and so forth. But as a real estate investor, it's too expensive for me because then the cash flow doesn't make sense based on the amount I spent on the property. That's what we teach you here on the channel. So it doesn't make sense. So I want to watch Boise. Okay, that's the #1 housing market in the country. according to Redfin and all of the data. Will we see a big swing there? Will those now they're building like crazy in Boise right now, like crazy. You cannot drive down a street without hearing a hammer. I mean, it's everywhere. They're building homes in Idaho because so many people are fleeing California. But will we see a dramatic shift in prices in places like Boise? I'd be fascinating to see. Also, the Bay Area, which is wildly overinflated in prices. Orlando, overinflated in prices. Will we see a settlement there? And then other areas, we may see just like a slight little fluctuation, 15%, 10%. For me as a real estate investor, I don't care much at all about the value of the home that I own. So I don't know the value of the homes I have. They're cash flowing real estate. That's what I care about. Real estate for the purposes of cash flow. The fact that they appreciate year over year nicely is great because it's a hedge against inflation, right? And I also get the tax benefits of that real estate. But if it drops in value 5, 10%, I don't care because I have a tenant paying the rent. And if I had financing on that property, nothing's changing. Nothing's changing. And we build our homes and we invest in real estate in really recession-resistant markets. Where we have a diversity of jobs, healthcare workers, and yes, you're going to have vacancies from time to time. We have a few vacancies, like in a couple of our New Jersey properties, but that's why my whole saga about investing in New Jersey, it's not something I will ever do again. But I have some properties there, and we have a few vacancies on a few of those properties now. But in the more recession-resistant cities where I'm focusing all of my attention these days, I don't have any vacancies. That's not to say I won't. I'm just saying that it's less likely because of the diversity of jobs that are more stable, government jobs, healthcare jobs, school jobs, university jobs, and those aren't going anywhere. But right now, banks and insurers are going to be the first again here to cause a major crash. With home prices in decline, values in decline, homeowners saying they don't have, they might not even want to sell their house, buyers who are now maybe even way more reluctant to buy because they just lost their job, they don't have income, they're not going to be able to get financing. Good luck getting financing when you have no job. So what are you going to do? You're going to have to rent. And I hate to say that, I mean, it's good, it's good news for landlords out there. But then we also have the rent and mortgage cancellation movement that's happening across the country. We want to say cancel rent, cancel mortgages. So until we get out of this craziness with this virus and can see where all of the dust settles, we won't know. But I can tell you this, right now, with the way that these mortgages are being bundled, people losing their jobs, not able to pay these mortgages, you're going to start to see a lot of foreclosures, folks. And especially in the commercial space. I think the commercial space is absolutely going to be crushed. So all of those strip malls that you drive around and see, that has the little pizza shop, has the little framing store, has the shoe store, whatever it is, all of those have been closed. And those owners of those companies can't pay the rent to the landlord of that strip mall. You're going to see empty strip malls all over the country. And sadly, this happened last time. We didn't have, or it happened before in part, malls and so forth. We didn't have, a lot of churches came in and set up shop in these places, right? Churches popped in here. But there's not enough churches to fill up every one of these places. Not going to happen. So you're going to see a lot of empty strip malls. It's going to look weird across the United States. I think there was also a lot of people were excited about building warehouses for distribution centers. I think a lot of those have been overbuilt. So we probably have more than enough warehouses that we need right now. And so that could be a blight also, empty warehouse space. And particularly one of the biggest things that's getting crushed, of course, is the hospitality and hotel business, because those were overbuilt. There was it was like a land rush. Everyone building hotels because we're happy times, good times. They've overbuilt all these hotels, saturated, and now those are going to go belly up. So I think, in the rental housing market, we have a absolute affordable housing crisis in this country. We still need 25 million affordable homes for rentals. So that's not going to change what I do. But from a retail housing perspective, we are sitting on the verge of another major collapse. Thanks to the big banks bundling up these loans, now we're out of work and we can't pay these mortgages back. Look for these foreclosures to pop up. You know, and you might be able to swoop in and get some great deals. And that's what happens. It'll become a cash buyer's market all over again. And I think that that's what we're going to see going forward. I think this is going to really even, could hurt the wholesaler market as well, because once you start to see these big home declines in prices and values, then flippers are not going to want to get into it and not going to want to spend the time, 8 months, 9 months flipping a house. And so wholesalers could also be really hurt in this. So a flipper is not going to want to pay a wholesaler $10,000, $15,000 if their profits are already being crushed because of this. So that's the latest on the housing market.